Good morning, everyone. Thank you for joining us here today. I'm Mitch Blaine, Executive Vice President with JLL, based here in Kitchener, Ontario, serving Southwestern Ontario. We're excited, and you can all join us today for the session, really focusing on commercial real estate market in the broader context of the Canadian market and also the capital markets, but how Southwestern Ontario really fits into that mix. Our goal today is to arm you not only with some data and forecasts, but also with the pulse of the fall market over the last number of weeks, hoping to give you some guidance on decision making, highlight some areas where we think there's opportunity, but also flag some areas where we think risk deserves more attention.
Thanks, Mitch. I'm Chris Kotzeff, Executive VP in the Kitchener office as well. To help frame the discussion, we're joined today by two of our colleagues at JLL, our Head of Canadian Research, Scott Figler, and our Head of Canadian Capital Markets, Matt Pickin. Both of these leaders will give us a detailed look at the bigger picture and illustrate how Southwestern Ontario fits into the larger picture. To get us started, we'll turn over to Scott to kick us off. Scott, over to you.
Thanks, Chris. Thanks, Mitch. Appreciate the opportunity, and thanks to everyone in the audience out there for joining us and taking the time out of their day. We'll be sure to make it worth your while. It's an interesting time right now. I feel like I'm saying that every time we give one of these, so I don't even know if it's worth saying anymore. It feels like over the last 5 years, any presentation we've given on the market feels especially timely. So I guess I might just stop saying that it's an interesting time. We're just kind of living in a turbulent, ever-changing market, way more than it was kind of before 2020. So, on the research side, we're definitely getting questions all the time, coming up across a variety of sectors. And so, we're really kind of making an effort to be out there, proactive with our insights, and we definitely welcome questions from the audience. We're not going to take any Q&A on this call, but we will follow up. If you guys out there have any questions, just shoot us a note. We will get back to you because there's a lot going on and there's a lot to cover. So let's jump in. We're going to start just by looking at the economy, some of the big themes that are happening and how it's relating to commercial real estate. Then we're going to look at capital markets, how that's impacting liquidity across different sectors. And then we're going to go for a deep dive into the office market, into the industrial market. And as Mitch mentioned, we are going to kind of showcase how Southwestern Ontario fits into the bigger picture across the national landscape. So we're going to start by looking at the economy. What are the main themes that we're seeing impacting commercial real estate? There's a lot going out there. I kind of broke it down into a few overarching themes here. So first of all, economic performance, economic growth. We're starting to see the impact that tariffs are having, geopolitics is having, the uncertainty that it's playing, and the impact that's having on the market. We'll dive into the impact that's having. Labor markets, unemployment, we're starting to see the impact feeding through there. The Canadian economy shedding over 100,000 jobs in the last 2 months. Unemployment, particularly hitting temporary foreign workers and youth most. Demographics, how that's playing out. We've seen huge population shifts over the last few years. Now that's starting to normalize, but there's been a lot of cities within that have been winners and losers. So we're going to talk about that. Monetary policy, how are Bank of Canada decisions playing out? How are they impacting markets? We obviously just saw a rate cut last week, but the impact that that's having on bond yields, which are really the determining factor for real estate liquidity, how that's playing out is less clear. And then looking ahead, just talking a little bit about some of the big things coming up, the renegotiation of NAFTA, and some important federal government initiatives to diversify trade relationships and investing in infrastructure across Canada to sort of counterbalance a lot of the uncertainty and noise that we're seeing globally. So to kick us off, we're going to just take a deep dive and look at what's going on with economic growth. So if you think about this kind of in different phases, 2022 and 2023, early 2023, we kind of saw this surge in the economy. This, if you remember, going back to these times, this was when there was a bit of inflationary pressure. We were coming off of the inflationary highs, but it was still there. And then early 2023, the Bank of Canada obviously began their interest rate hike cycle. This dampened economic growth. We get to a nadir in the fall of 2023 where the economy contracts by 0.6% annualized. And then we start to see a little bit of steady momentum and rebound, culminating kind of in, I would say, fall of 2024. If you think back to where we were a year ago, obviously there's a lot of positivity, there was a lot of bullishness. And then what happened? Well, there were certain elections happening around the world that led to kind of a bit of a wait and see attitude, kind of end of 2024, early 2025. And then as talk of tariffs kind of heated up and turned into action, we now, as of Q2, are seeing the impacts with the Canadian economy contracting 1.6% annualized. I want to make a distinction. That's an annualized figure. So the actual contraction was 0.4. But to speak in annual terms, we just multiply it by 4 and present the annualized figure to get a sense of what that looks like, comparing to historical annual growth. So in a typical year, the Canadian economy will grow about 2.2%. And so you kind of see how we've been performing over the last few quarters relative to that. So starting to see the impact. It's been mostly driven by a fall in net exports and a fall in investment in capital equipment. So exports were down 27% from Q1 to Q2. Investment in machinery and equipment down 33%. So, and then the other side of that, which is interesting, is that household spending increased. So we're not in a recession. A recession would be 2 consecutive quarters of negative growth. So we're going to have to wait until December to see what the numbers look like. But what we know right now is that this is a slowdown that's driven, I would say, almost exclusively by what's happening with tariffs, because it's basically been exports and business sentiment that is holding off. Businesses are holding off on investing in people, investing in capital, investing in machinery, and that is what's causing the dip. It's not about consumer spending. It's not about sort of underlying consumer sentiment. It's just about what's going on with tariffs. It's also starting to feed into the employment market. So if you look at kind of over the last few years, the economy was adding, again, late 2022, early 2023, the economy is adding between 50,000 and 100,000 jobs per month. That starts to slow as we go into 2023. Fast forward to where we are so far this year, you can see that on a monthly basis, job growth has been pretty subdued. And over the last 2 months, we've actually seen around 100,000 jobs shed in the Canadian economy, with the unemployment rate rising to about 7.1. That's the highest that we've seen in about 13, 14 years. And I would just add on top of that, this is a headline unemployment rate, but if you look at unemployment for youth, so 15 to 24-year-olds, unemployment rate is about 15%. And if you zoom in even further to 15 to 19-year-olds, so your people in high school, just out of high school, people looking for summer jobs, that unemployment rate is about 20%. So it's a very tough summer for youth finding work. So how are tariffs impacting local communities? And that, again, that tariff uncertainty, which is just important as the real impact. This is a map showing kind of on a county by county basis the dependency on jobs tied to exports to the U.S. So you can think of this as a heat map that basically measures, how much are different towns impacted by tariffs and rising tariffs. The deeper the orange and red, the more impact. The darker the green, the the less impact that we're seeing. So it's really kind of no surprise if you study this stuff. Windsor and Guelph, kind of that southwestern Ontario corridor, is sort of the epicenter in Canada for a lot of the talk around tariffs and the impact that it's going to have. Not to say that it's been all bad news. In a second, I'll call on Mitch, who will talk a little bit about the other side of what's happening and some of the positive silver linings that are happening. But what we know so far is that some of the towns that are most affected, Windsor, 9.8% of the labor market is tied to exports to the U.S. Not a surprise given where it sits across from Detroit. Guelph, 9.4% of workers in Guelph work for a company that provides goods for U.S. consumption. Waterloo region is also high up there, 8.1%. And then kind of the further you go towards Toronto and east of Toronto, the lower that number gets. So you get all the way over to Oshawa, you're at about 3.7%. So that indicates that kind of on that end of the GTA, there's a lot of companies that make stuff for not US consumption, but for Canadian consumption. The larger cities, Toronto, Vancouver, Ottawa, a lower percentage. So that means they're much more insulated. Not a surprise because bigger cities have more diversified economies. They're more dependent on service sector. So Mitch, I'm going to turn it over to you. What impact are you seeing in your corner of the universe on this stuff? How's it playing out from your perspective?
Yeah, I think a lot of it was just a wait and see attitude. And if you'd asked that question, Scott, on Liberation Day with President Trump's poster, a lot of the requirements just ultimately paused. I would say the biggest shift we saw through August going into September, is we are seeing a lot of those deferred decisions because of the tariffs, and the concerns start to move forward. In certain cases, we're seeing some net loss of, I would say, productivity, employment, plant shutdowns. However, there seems to be a real profile there that exists around older, outdated facilities. And I mean, it's not uncommon in these cycles to see a flight to quality that happens. At the same time, not all supply chains are created equal. And depending upon what industry you serve, obviously automotive, Windsor, Guelph has a fairly big impact, especially as we go through these CUSMA or USMCA negotiations. But if you think about food production, we've seen quite a bit of activity in that sector in Ontario that's been net positive with investment. And obviously, our Ontario government's quite active in helping facilitate more of that investment, especially in the food sector. So it's been a lot of mixed bags. Everyone froze at the beginning, Scott, to answer your question. But now we're starting to see who's actually mobilizing. Early signals, especially in the last couple of weeks, of even the automotive folks starting to make some decisions that are positive for Ontario. We've seen a number of stats coming out of the US-Mexico activity along the border, which is encouraging, I think, for Canada. Obviously, we've got to get through the next number of months in negotiations with CUSMA, but some encouraging signals. That's not all doom and gloom either. I mean, I look at this heat map, and I think this is arguably looking at somewhat worst case scenario, and there will be some damage, but you're starting to see some green shoots in certain industries, which is encouraging.
Thanks, Mitch. Yeah, and so this next chart, I think, is important to keep in mind. There's a lot of talk about kind of those Liberation Day, the poster, and tariffs that have been announced, which I think is the last I checked, and it moves so fast. I apologize if this isn't exactly right as of yesterday, but from what I understand, it's 25% blanket tariffs for non-CUSMA, 50% steel and aluminum, 50% copper. There's also softwood lumber tariffs that impact Northern Ontario and mostly impact BC. But what's important to keep in mind is that around 88% of trade flows from Canada to the US are covered by the North America Free Trade Agreement, otherwise known as CUSMA, otherwise known as USMCA. Every country has their own letters for it. But what's important to keep in mind is the effective tariff rate, which is still around 2% for Canada. So if you take the total trade of Canada going towards the US, divided by the total tariffs that are paid to this government, it's still a pretty low figure. So it just kind of suggests that, a lot of what's happening right now, not to say it's noise, because as we've seen, it's really had an impact on the economy, a tangible impact, but really the main event is the CUSMA negotiations. So that's really what the government is focused on, and that's where, a lot of the impact that we're going to see is either going to play out or not play out, depending on what happens with that. Another thing to look out for is relationships between Canada and Mexico. There's a lot to be done there. This is a completely untapped gem, and all parties are realizing that now. You saw the meetings last week between Mark Carney and Claudia Sheinbaum. There's a lot to be done there. There's rail connections that bypass the U.S. Look for broadening relationships between Canada and Mexico, Canada, Europe, Canada, Asia Pacific.
And Scott, if you don't mind me jumping in there, I mean, that graph's really telling, and we're starting to see actual decisions get made where inventories and or capacity is being somewhat assessed or relocated from overseas to closer, obviously some into the US, but there are deals happening in the industrial sector right now that is a relocation of inventories and or productivity to Canada, to Mexico, getting away from, you can see that bar on the far right, that's quite expensive and there's a lot of risk there. So we're starting to see that play out as well.
So looking at inflation, this is going to be really important because the Bank of Canada and in the US, the Federal Reserve, they are completely fixated on what's going on with inflation, what's going on with employment, and they're going to look to try to drop rates if they can. That's a key if. In Canada, it's an easier case to be made to drop interest rates because we see inflation is pretty flat. The last reading was about 1.7. A lot of that is because the carbon tax was lifted in March, so fuel prices have fallen, and that you can see kind of the drop from March of this year, which has really been due to lower fuel prices. But be that as it may, inflation in Canada isn't really much of a concern right now. The concern is really about the employment market and stimulating job growth. In the US, it's a little bit of a different story. Inflation is on the rise, and that is even taking into account that most goods on the shelves in the US were ordered pre-tariff. So I was talking with a close friend last week who runs supply chain at a major apparel company, and he was telling me that we're highly likely to see inflation continue to creep up in the US because a lot of the stuff that's on shelves in the holiday season is going to be orders made post tariff. So in a lot of cases, we haven't even seen the tariffs baked into consumer products in the US. So there's a decent chance that inflation rate in the US ticks up. If it does, it's going to be very hard for the Federal Reserve to make the case to lower interest rates in the US. It's going to be a key thing to keep an eye on over the next few months. In the meantime, Canada is responding exactly how it should. You control what you can control. In a lot of ways, this is motivating decisions that should have been taken years and years ago. So we're seeing a lot of announcements for major projects. Obviously, the Trans Mountain Pipeline, which is connecting northern Alberta to Vancouver, that is boosting LNG exports to the Asia Pacific region. That's been a big buffer over the last few quarters, a reason why the economic impact isn't what it was feared. An LNG terminal here in Kitimat, BC. We're seeing new mining projects facilitated in northern BC, northern Saskatchewan. The Darlington nuclear facility in Toronto, which is meant to be sort of a pilot project for creating small modular nuclear energy. And then in Quebec, there's the expansion of the Contrecoeur container port. So again, the government is really fixated on controlling what they can control and expanding these programs. Also, the Build Canada Homes Act, which a lot of you in the audience will be impacted by, thinking about more directly about commercial real estate, streamlining residential construction. There's talk of resurrecting the multi-unit rental building program, the tax incentive that allows building depreciation to be tax deductible as it was in the 60s and 70s that led to a lot of rental housing. So, and then of course, as I mentioned before, diversifying trade relationships. So these are all things that in a way in a weird way, sort of thanks to Trump and all of the craziness going on, Canada's taking all these decisions that are going to make the economy more resilient in the long term. However, a key sort of headwind that we're starting to face is the slowing of population growth. This is a chart looking at the quarterly population growth rate across provinces. And you can see there was a peak generally around 2023, 2024, and now it's kind of normalizing. However, it's important to point out Alberta in green is still growing pretty fast, way faster than historical rates, even though it's slowing down. Saskatchewan, this line in blue, another province where we're seeing a lot of momentum, that's trickling into the retail market. It's trickling into the multi-residential market that's outperforming there. Ontario, on the other hand, this black line, really starting to slow down. Population growth in Ontario is kind of slower than it was pre-COVID. So this is going to be, again, something to think about from a real estate perspective. That said, we've already seen population growth impacting markets across Canada in a big way. So when you look at this, kind of what jumps out is there's, first of all, the Kitchener-Waterloo region has really outperformed, gaining around 13% population growth in the year since 2021. That's second in Canada, only to Moncton. I would say, when you think about the cities that have sort of been the net winners over the last few years, I really put them in three buckets. It's Atlantic Canada. So you see Moncton there, you see Fredericton, you see Halifax in the top 10. You see GTA spillover cities, so Kitchener-Waterloo, St. Catharines, Niagara, London, and Barrie. There are a lot of people moving from Toronto to those cities. And then the prairies, so Calgary, Saskatoon, again, talking about Saskatchewan and how it's starting to pop up as a winner kind of in the last few years. And then Vancouver, just being Vancouver. But really, it's driven by affordability, it's cost of living. And we're starting to see that play out in the real estate market, the benefits that's having. Chris, do you want to just kind of speak to, how this is impacting? I mean, I know you work with, a variety of clients in Southwestern Ontario, and what's been the impact of population growth on some of the companies you've seen?
Yeah, I think you may have already said, Scott, but the increase in labor force, supply of talent is huge. So it's helping to fill gaps in tech, advanced manufacturing, education. So that's been very important for our region. Because of the increase in international students as well, the universities and colleges are producing, very highly skilled graduates, which, relays into a highly skilled workforce. There's also a big increase, I would say, in demand for services overall, just general community services, real estate, more demand for real estate and places for people to live, infrastructure projects, which has really helped boost, construction projects along the way, and then an increase in public sector jobs and retail as well. Of course, the flip side of that is, you mentioned us being an affordable, market, and generally speaking, compared to many other Canadian cities, we are that. But we've seen a big run up in housing costs, rental costs. So it is something to monitor. We're probably not going to see our housing pricing get back down to a level that was pre-COVID. So we're kind of stuck in that, higher pricing threshold, which is still considerably cheaper than the GTA, but still expensive if you've been in KW for long enough. Mitch, anything you want to add to that?
Yeah, I mean, I know this is about affordability of, residents and, the labor pool, but I would say we're seeing similar impacts and assessments on affordability when it comes to industrial space. I mean, Chris, you'll talk in a minute about office space. Like, there's definitely, I would say tenants seeking value, and value being, cost relative to GTA, which I think is having a net positive impact on activity for industrial and office, not just residential, but I think it's also playing out in commercial real estate.
Agreed. Thanks, guys. So that's our economic overview. We're now going to jump into capital markets. So looking at sort of the capital flows behind real estate across different sectors. The first thing I'm going to show is just sort of where we're at in terms of overall capital flows. We use a threshold of 5 million. So when we talk about what's going on in the sale market, we're not counting that, parking lot that's sold for $400,000. We're kind of focusing on, that $5 million and up range. So the market peaked in 2022 at about 65 billion. Since it's been kind of fallen a few years consecutively, we're about 20 billion so far for 2025 across all asset classes. So on pace for, call it 40 to 45 billion. We're probably going to see a bit of a ramp up towards the end of the year. We usually see a rush of deal flows. So Q2 is normally kind of a bit higher velocity than, I'm sorry, H2 is a bit higher velocity than H1. So, I would put my money on landing somewhere around 45 billion for this year. Probably going to be the third straight year of decline. But again, there's silver linings in there. That it's a complex story. So if you look at this on a quarterly basis, last 2 quarters, we've been basically at the same level of about $10 billion in sales. Again, when I was talking earlier about that momentum that we saw a year ago, we saw a big jump in Q4 2024 in sale volumes, and then they've kind of dissipated thanks to a lot of the noise, geopolitics, wait and see attitudes. Matt, I'm going to turn it over to you. Can you talk real quickly about just what are you hearing from investors heading into the back half of 2025? Are they bearish? Are they bullish? What's your take?
Thanks, Saul. I would characterize it as impatience. I think there are many investors who've been sitting on the sidelines for the last little bit, lots of dry powder, eager to deploy capital, but candidly having a tough time reading the tea leaves. I would say that when you compare this time to last year, investors seem to be a little bit more risk on. And when I mean my risk on is that impatience is growing and we are beginning to see some green shoots. Definitely, there's still some stagnation in the leasing markets. There's a little trepidation. Groups are waiting to see if a trade deal can get signed. So we haven't seen a massive uptick in industrial leasing activity, for example. But we are seeing some green shoots in other asset classes, which I know Scott's going to talk about. The office asset class, we're starting to see an uptick in activity. We're seeing renewed interest. Retail is the darling of all the asset classes. So I think heading into the back quarter of the year, deal velocity is going to pretty much stay the same, but I can tell you based on JLL's BOV activity, we call that broker opinion of value. We like our acronyms at JLL. We are certainly getting a lot more requests. I think more investors have come to the realization that a lot of the institutional investors have marked their assets and they're ready to sell at a price at which the market will bear. And that wasn't the case a year ago. It wasn't the case 2 years ago. So you do have some bargain hunters who've been sitting on the sidelines and they realize that now on a relative basis is the time to strike.
Thanks, Matt. Yeah, one of the reasons why it's been, we haven't really seen the velocity that we had hoped in the first half of the year. Obviously, tariffs and kind of geopolitical uncertainty, but that it's also because of bond markets. So we all know that the Bank of Canada has been lowering interest rates on the overnight lending rate. That's this black line here. You can see these downward steps. The prime rate up here, which is a few points higher, this is generally the benchmark for construction loans. So that has helped. But when you talk about most acquisition activity, when you get a mortgage from the bank to buy a $100 million office building, the vast majority of players are taking on debt that the banks are sourcing benchmark to the bond rates. So if you look at what's happening in bond yields, again, going back about 18 months here, you see them start to come down here a little bit with the drop in the policy rate. This period, again, going back a year, late 2024, this was a low point for bond yields generally. And this is when we started to see a lot of investors getting back into the game. And then you have some kind of, geopolitical noise, tariff uncertainty, bond markets a little concerned, coming down a little bit with more policy rate cuts. But then over the last few months, it's been pretty steady. They've actually gone up. They've come down a little bit with the last cut announcement, but they're generally kind of in that same range. The 10-year, which is probably the most common for real estate benchmarking, has pretty much been in that 3 to 3.5% range, going back, a few years. So despite the BOC policy cuts, it's really this 10-year yield and the 5-year yield that institutional investors are looking at, and those really haven't moved as much as was hoped. Why? It's because bond markets are concerned about government debt. They're concerned about geopolitics. They're concerned about long-term inflation, and they want to be compensated according to those risks. So it's really going to take efforts on those things for bond markets to come down considerably. That said, a few more policy rates could help. So we'll see what happens over the next few months of the year. Looking at kind of sector by sector, so the global financial crisis, we get asked all the time, what's going on now? How does it compare to the global financial crisis and what happened in real estate? So this is looking at annual returns by sector. So global financial crisis, Canada as a whole, according to the MSCI RealPAC Index, Canada as a whole kind of went negative, call it 0.5% returns for 2009, and then bounced back pretty strongly. 2 years later, it was at 15%. So the lesson is the market swings back. Even COVID, we were down 4% on the whole in 2020. The next year it swung back and we were plus 8%. And then there was, again, a lot of that noise, higher interest rates that pushed returns down. We're now kind of in a recovery period, as of 2025. The Canadian market as a whole, call it 3% annual returns right now, is kind of where we're at. But you also see the sectors sort of converging on performance. Industrial for a few years was absolutely off the charts. If you owned industrial, you were getting a crazy, the benchmark was a plus 30% return in 2021, 2022. Mitch Blaine was he was getting a lot of calls then. He's still getting a lot of calls, but they're different types of calls. But it was a different time, and the industrial market is normalizing now. Retail, on the other hand, retail and office are kind of, as Matt said, they're kind of on the come up. They're bouncing back. But what's interesting is we don't have this huge divergence in performance across different sectors. We have a convergence. We have, pretty much wherever you play in real estate, there's challenges, there's opportunities, there's risks, but there's also silver linings. It really comes down to, your knowledge of the local market, your tenant base, your covenant, property management, kind of the nuts and bolts of the game. That's really what matters now. It's no longer is it a safe bet to go in this asset class or that asset class. So, we've talked about a lot of the challenges facing the market. Now we're going to talk about an opportunity. So what we're seeing right now pretty much across the board is oversupply. This is looking at square footage completions across all sectors: office, retail, industrial, well, all commercial sectors, leaving out residential for the moment. But I'll come back to that. So 2023 and 2024 have been a boom in terms of deliveries. Why? Because a lot of construction loans were financed a few years prior when interest rates were at rock bottom. So you could get a construction loan very cheap in 2021 to build an industrial building, to build an office building. Well, not many people were building office buildings, but you get my point. So a lot of that stuff is being delivered now. What's happening now? Over the next few years, construction is going to taper off. We're seeing this across all asset classes. So while the market right now is a bit oversupplied across different sectors, and that's weighing, certainly we're seeing negative rental growth in industrial, and most of the office market, that's going to shift in the next few years. And it's going to shift because supply is going to start drying up. Towards the back half of the decade, we could be in a supply constrained environment again in some of these sectors, which is going to encourage rental growth. It's going to encourage much better returns. So again, in real estate, we want to think about using I'm an American, but I'll use the Canadian metaphor of think about where the puck is going to be. I say think where the football is going to be, but to each their own. Where the puck is going to be a few years from now is, it's going to be a different dynamic. It's going to be a bit more supply constrained. It's going to be a bit more landlord favorable. So keep that in mind. We're starting to see that sentiment impacting the office market and the retail market. A lot of investors are thinking, a step ahead in the future, and they're seeing that the office market, um, they're seeing that availability has peaked, which we're going to get to in the next section. They're seeing that we're going to be kind of entering a more supply constrained environment, especially on the high end of the market. Retail the same, and that's driving a return of bidding activity. This is our proprietary bid intensity index. Basically, what we're doing here is we're looking at bidding activity across the globe, across all sectors, and we're measuring where final closing price is shaking out relative to asking. So this black line here, this dotted line is, think of this as the average asking price. Over the past, year or so, industrial and multifamily bids have been coming in way higher than asking. That's starting to normalize more on industrial. It's starting to kind of fall in line with asking. Retail has been surging. Multifamily continues to be above asking price on average. But then office, you look at where office was in the past few years, coming in, 5-10% below asking on average global. That's starting to change, and we're starting to see office bidding activity seeing some upward pressure. Matt, is this, I'll turn it over to you for a second. Is this kind of jiving with what you're seeing?
I think it is, and I think if you look at the if you wouldn't mind actually going to the previous slide for two previous slides for 1 minute. Sorry, I'm going off script here. This one more. Yeah, this one. So you can see the office line, and Scott, if you want to maybe track over the line, it got hit really, really hard. And if you look at the office market, the the segment of the market that owns office, certainly the institutional, call it the shiny trophies, those are predominantly pension funds and REITs, and sprinkled in with a few foreign buyer owners as well. You don't really have the big family offices owning the towers. It was a bit of sticker shock, I think, for many of these groups to come to the realization that these buildings are not worth what they paid for them or what they was on their books at, and they have subsequently been writing them down. And so they took their lumps, they've written down these assets, and don't forget these lines are a combination of income and a capital markets kind of return or capital return. So you had a double whammy effect where office building owners were seeing deteriorating occupancy, rents were going down, TIs were going up. It was not a great time to own an office building. Many of these were cash flow negative. And at the same time, cap rates were decompressing, they were going up. So you had this combination that was leading to a deterioration in value by as much as 40% in some cases. What's happened since then? You've seen a massive uptick in leasing activity. When Scott and his team put together their notes and they tally up all of the all the research from the last quarter, we will see that there's been a massive resurgence in office leasing activity, predominantly led by the banks, but others with the return to office. The bank, or rather, the federal government is now starting about getting their workers back into the office. So that combination, the uptick, it's still a tenant market, but the pendulum is starting to swing. And at the same time, with bond yields coming in, it's become a point now where these office buildings, it's starting to look a little bit interesting. We're in a situation where you can pick up a Class A office building downtown Toronto at a cap rate that starts with a 7. That used to be in the 4s. And when you consider that you can finance that at just under 3%, there's a nice window there, a nice little spread for positive leverage. So put all that together, I would say the office market is still, it's not out of the woodwork yet. We still have some challenges, and I think what's really going to save the day for office building owners, and this is key for those of you on this call who are owners, who are on the management side, it's about operational excellence as opposed to financial engineering. In the old days, you could write down and prognosticate and come up with IRRs all day long to make it look like it'll be a great deal. but that won't save the day anymore. Now it is really about how are you going to bring this asset up to a level that will exceed the market, or at least will be at par on the market. So yes, we're seeing an uptick. We've sold 2 major office towers in Canada so far this year, one at Queen and Yonge on behalf of CPP, Aimco, and Brookfield to Queen. That was the end of last year, actually. And we recently sold 2 office buildings in Vancouver on West Pender on behalf of Cadillac Fairview and their partner, Aimco. And we're selling some buildings in Southwestern Ontario and GTA as well. So this is definitely a sign of things to come, in my opinion.
Yeah, thanks, Matt. I'll take that opportunity to make a shameless plug, not only for our capital markets team represented here, but also our property managed group that focuses on, how do you improve NOI across buildings? Because we're seeing that becoming a huge part of the business. As Matt said, we're getting away from financial engineering with more of a focus on management excellence. So I'm going to dive in now to the office market. If you were paying attention, you would have seen our cover slide that said it had a neon sign saying return to office. I don't know if that was AI generated. I just found it as a cool looking image that I found on the internet, but that's totally the story right now. For a few years, the office market was slow, leasing was slow, weighed down by hybrid remote work, some tenant downsizing. We are now seeing a retrenchment happening pretty much across the board. So we'll get into that and we'll explain why. So this is a chart looking at supply and demand. The light blue is new completions. The dark blue is net absorption, so take up of space, gains in occupancy. And then this dotted blue line here is the availability rate, and that beige line is the vacancy rate. I won't get into specifics. Availability rate is a little bit of a leading indicator for vacancy. We track both. But if you look at the availability rate, it peaked a few quarters ago. We are now in 3 straight quarters of falling office availability. A lot of that's driven by the high end of the market, the quote unquote trophy segment. But vacancy is going to follow because vacancy is occupancy. So essentially, what's happening is companies are leasing, which is driving the availability rate down. There's less spaces available. But then when they take up occupancy a few months after leasing, once they build out their space and become operational, at that point we measure absorption and vacancy as falling. So the fact that availability has been going down, we are probably going to see a fall in vacancy either this quarter or next quarter. We are at an inflection point in the office market. And as Matt said, the wise investors who are looking at this stuff and not just looking at the alarmist headlines are taking note. The other major shift that's happening is you look at that light blue, that's new supply. It's falling to about a 30-year low over the next few years. So there's going to be very few office buildings constructed. We've heard whispers about a new tower in downtown Toronto. We've heard whispers of a new tower in downtown Vancouver, but nothing announced yet. Even still, it's still going to be pretty subdued by historical levels. This is going to allow the market to continue catching up. It's going to allow the demand to continue channeling into existing buildings, which is going to drive availability and vacancy rates down further. And if you look at gross leasing, so this is looking at kind of all leasing, whether it's renewals, new leases, subleases, all of the above. There's kind of general leasing activity. You can see over the last 3 quarters, we are pretty much at pre-pandemic leasing volumes. So that's important to keep in mind. And if you look at net absorption, which again, slightly different indicator than leasing. Leasing is deals that are signed. Net absorption is gains or losses in occupancy. So once a company signs a lease, a few months later, they take up occupancy, they leave their old space behind. The net impact of that is what we call net absorption. So you can see going back to 2021, it was we reached a bottom of about -4 million square feet in this quarter in 2021. You have some ups and downs. Generally, it's been improving. This last quarter, Q2 2025, was the first quarter in about the last 6 quarters where we saw positive net absorption nationally in the office market. So what are the drivers there? What's going on? Well, certainly hybrid work is a big part of that, but we've also seen just organic growth in companies. So whether your company is adopting a fully in the office approach or a hybrid approach, um, either way, they've probably hired a lot of people in the last 5 years. So that's what we're looking at here. In certain cities, this is impacted more. So Calgary, which is, I would say probably the market that's been most on fire over the last 2 years. Calgary has added 40% of what we call office using employment. So tech, finance, public administration, et cetera. Um, that's that's been around 75,000 new office using employment in Calgary. Again, not all of that is fully in the office. Different companies do it different ways. Certainly, there's some hybrid work that's still happening and probably going to keep happening for a long time that might be entrenched. But if you're in 3 days a week, that's still a seat that the company needs to take into account. So organic job growth is a huge factor here. That combined with supply essentially drying up across the board is really leading to a shifting dynamic in the office market. The other thing is subleasing. So for a few years, subleasing was really kind of a common strategy for tenants to sort of shed cost. We're starting to see, on one hand, this chart on the right, sublease availability has fallen over the last few years consistently. Part of that's because they've been leased. Part of it's because spaces that were listed on the sublease market have just expired on the head lease and become head lease vacancy. So it can be a little deceptive. But the one that I really think about a lot is new sublease listings added to the market. That's how you really know if tenants continue to pursue the sublease strategy. We're seeing over the last 18 months, call it, really a significant decrease in the amount of sublease listings added to the market. Just this last quarter, there were about 150 across Canada. You compare that with where we were at, peak 2022, 2023, when there were around twice that level of new sublease listings added to the market. So what does that mean? It means a lot of companies are saying, actually, I'm going to hold on to that space. I care more about, what is our headcount going to look like over the next few years, more than, how can I save, a few $1,000s here or there on rent. We're really seeing companies focus on what their headcount is going to look like and what their productivity and growth is going to look like. And that's why we're seeing a resurgence in office activity. Chris, what is this jiving with what you're seeing in KW? What's your sense of where things are going?
Yeah, just quickly, you said a lot of things that I would reiterate, Scott, but I think in 2025, we finally get to say, KW specifically, that we are having a bit of run in office leasing, which is a nice thing to say after about 4 or 5 years. Definitely an uptick in activity this year for sure. There's a lot more tenants in the market right now, just looking at space, than there were 6 to 12 months ago, and I mean a lot more. There's always been really strong activity in that 5,000 square feet and under segment of the market, but what we've really noticed is there's a big increase in that sort of 10,000 feet and up category, which is something we haven't seen in about 4 or 5 years. I would say another noticeable trend is that tenants are starting to commit to longer term leases as well. So for a lot of years, on working on lease renewals and things like that, we heard a lot of this. We want to renew our lease for 1 or 2 years while we sort out what we need. Now there's a lot more commitment and a lot more of this, traditional 5 to 10 year leases being contemplated and executed on. And I think it's just companies are feeling a lot more confident in, strategy and long-term decision making around how they're using spaces. And just quickly too, and I think this is, likely a trend in a lot of other cities, but, here in KW, the suburbs definitely seem to be the most active areas for leasing activity. Parking, in this market is a very, very big driver for that. It's free in the burbs. There's lots of it. But we are starting to see some of the downtown landlords actually talk about giving some free parking, at least for a period of time within deals to attract tenants to come back downtown. So I think we'll see a lot more of that. and probably a bit more activity in the downtown urban centers as that continues. But overall, like I think, like you said, Scott, there's a lot going on in office right now, and I think that's going to continue for the next 12 to 24 months.
Thanks, Chris. So I'm just looking at the clock. We have about 10 minutes left. So I'm going to jump ahead to the industrial market. I want to make sure that we have time to speak to that market. And we can send this deck as a follow-up. We do have a few slides that we unfortunately couldn't get to, but I want to make sure that we have time for this discussion because it's also pretty interesting what's happening here. So, looking back over the last, call it 7 years, you can think about what's happened in the industrial market in terms of, this pre-COVID era where we saw, these blue bars are demand, net absorption, the beige is new supply, and that black line is vacancy rates. So you see kind of demand sort of consistently outpacing supply. You get a bit of a rise in supply towards the end of 2019, but generally speaking, we see vacancy falling, markets tightening. And then COVID happened. And, for a few months, we thought the world was going to end. We quickly realized that it wasn't. And we quickly realized that we were going to need a lot more warehouse space because people were buying things online. Companies were moving towards an omni-channel strategy, selling straight from their warehouse. And so then we started to see demand beginning to outpace supply, and that pushed vacancy down to, a low of around 1.5% in kind of the middle of 2022. And then there was this rush to build. So this supply response that we saw in 2023, early 2024. And then at the same time, interest rates rose, the economy started to slow, demand cooled off. And so that's kind of where we're at heading into 2025 was this dynamic of a huge supply response, slowing demand. But then again, towards the end of 2024, it's this theme that we keep coming back to. We saw strong demand towards the end of 2024, again, just before a lot of that geopolitical stuff started to impact markets. And then we see demand cooling over the last 2 quarters as supply remains at a very high level. It's pushing vacancy up, hitting close to 5%, which is the highest that it's been in about a decade in Canada. That's kind of where we're at in terms of the industrial dynamic. How that's playing out market by market. Well, the cities that saw the biggest surge in supply over the last few years saw the pendulum swing the most. So if you look at Montreal, here you have vacancy at about 1.3%, shooting up to 6.7%. Montreal saw about 16 million square feet added to the market. Southwestern Ontario, in a second, we'll hear from Mitch. You saw vacancy rates going from 0.5% now at 5.3%. Southwestern Ontario added about 10 million feet, but proportionally for the size of the market, that was a huge increase. Toronto added around 54 million square feet. So we saw a vacancy shoot from 0.8 to 4.9%. Vancouver, similar dynamic. Now, where things have been a little different is Edmonton and Ottawa. They didn't see a lot of that supply hitting the market. So they've stayed mostly balanced. And now where Ottawa and Edmonton and Calgary have the lowest vacancy rates in Canada. But really, it's a nuanced story, and I'm sure Mitch will agree with this. This is just looking at Toronto, but it speaks to kind of what's happening nationally. If you think about the industrial market in terms of small bay, mid bay, large bay, we really see kind of how things are playing out. So this chart on the left is average rents. And again, this is just Toronto, but you can sort of extrapolate this to a national level. The highest rents in the market are in that small bay segment. And a lot of times these are older buildings. So, you have, rents in that 10 to 20 square foot segment of the market pretty much unchanged, coming down very little from their peak of $19. Where have rents come down the most? In that medium to large bay segment of the market, you see the largest segment kind of coming back a little bit on net rents. But then if you look at vacancy rates, this is a really telling story. That large bay, so 250,000 feet and up, you saw vacancy shooting up to 7.4%, whereas in the small bay segment of the market, you've actually seen vacancy falling over the last few quarters. Buildings below 20,000 feet, a 1.5% vacancy rate. Mitch, is this kind of consistent with what you're seeing?
Yeah, and I mean, it's also telling of, what and who is active as tenants in the market. From our data in Southwestern Ontario, you can clearly see most of the leasing activities coming from local groups. And I mean, when you start thinking about your average tenant size in a place like Cambridge, Ontario, London, Ontario, they're usually sub 50,000 square feet. And that part of the market never really saw a big surge in new supply. And so we are chewing away at a very limited stock of older product in a lot of cases. We're even starting to hit the point where pro formas are getting close to hitting feasibility on new development of this smaller bay industrial product that can really help service more of the local tenant base and the average deal size. So really encouraged by some of the signals from the smaller bay product. But I would say your graph, Scott, on new deliveries is drawing up very quickly, big and small. And even the larger product, Cambridge had a fairly robust development pipeline, is starting to absorb. It's going to take some time. A 400,000 square foot building, you got to chip away at 100,000 here and there. But it is absorbing, and there's nothing really in behind it. So to your point, Scott, I do believe we're going to see pent-up demand surge here once we get a bit of visibility on CUSMA and trade, because a lot of the requirements, especially slightly larger, went to the sidelines, waiting for some clarity on that. And we may hit a point where, like you said, we're pretty starved of space if you fast forward a year to 2 years from now.
Yeah, and if you look at kind of the peak of the construction cycle, we were at 52 million feet across Canada under construction here in mid 2023. You fast forward almost 2 years, we've kind of chewed through about half of that's been delivered. In another 18 months, we could be at, pretty historical levels of, in terms of a low of construction pipeline as developers kind of hold off and fill up the existing inventory. So, to Mitch's point, 18 months, 24 months out, we could be in a very different dynamic where we see markets beginning to tighten up again. The last point I want to make, and then we'll have some concluding remarks, is just on where rents are going. So if you look west to east across Canada, you see kind of the markets that built a lot. You see rents falling quite a bit. So Vancouver rents peaked around $23. Now they're kind of approaching 20. Southwestern Ontario peaked around 15, now down around 13.5. Toronto peaked. I would even say, like, in certain cases, we were seeing rents hit $20. Now the average is kind of around 17.50. And then Montreal has come down quite a bit as well. Rents have been steadier. Again, Ottawa, less of a supply shock. Winnipeg, the prairie markets, Calgary, Edmonton, Winnipeg, have been much more stable in terms of rental growth. They're still seeing rents going up for the most part. I have one more question, and I'll turn it over to Mitch and Chris to conclude the presentation. But Matt, before we adjourn, on rental growth, underwriting industrial properties, I know this is what you deal with on a day-to-day basis. How are investors thinking about underwriting rents in a market like this?
Ooh, that's a good question. I'll tell you, we rely on our industrial partners a lot more. We like to think we're capital markets experts. We do okay, but really you have to lean on your partners who are living and breathing in that space. What I would say is it's kind of a tale of three cities, if that's an expression. We have small, mid, and large bay. Large bay boxes are getting hit hard, and you have to underwrite accordingly. There are a lot of big empty buildings out there, a lot of owners competing for the same tenants. Mid bay, fewer of them. It's more costly to develop those, but you still are seeing kind of slow lease up for some of these assets. And then small bay, it's cost prohibitive to develop that, but we also have to really lean on our partners to underwrite. In the old days, we would have said anywhere from 5 to even 10% rental growth a year. That's how much we were seeing year over year. I mean, that was unsustainable. That was crazy. Now we have to really kind of pull in the reins. We have to assume more normal growth, which in the old days was kind of 2.5%. And in some cases, we might say 0% growth for 2 years, and then you start to grow it. All that gets synthesized. You throw it into Argus, which is our kind of big underwriting app, if you will, and then it dumps into Excel. But at the end of the day, most of the private investors really focus on price per square foot and cap rate as opposed to these DCF values. But yes, we have to be a lot more careful than we were before.
One other thing I'd just add to the lease assumptions, we need time. We no doubt saw a bit of a freeze in the industrial leasing market with the tariff announcements. As that thaws and as time moves on, we're getting more and more comps, more and more confidence around the leasing assumptions. And so I think time is also helping here, as it did in the COVID lockdown at first. Once we start to come out of it, you start to get some confidence that the market will bear a certain level. No doubt it's not as frothy as it was when we peaked, but you are, in a lot of cases, especially smaller bay products, starting to see a bit of a floor on rents, which is encouraging, which we think helps deal activity, both investment and leasing.
We do have some slides we didn't get to, unfortunately, but we will send this out as a follow-up. And again, I want to invite anyone out there, if you have questions, if you don't know us, you know us now. Here's our email addresses. Feel free to reach out. We will get back to everyone who has a question, and we'll send this deck out as a follow-up. So I'll turn it back over to Mitch and Chris. Thanks again for the opportunity to present.
Yeah, thank you, Scott, and thanks, Matt, as well, for all your super valuable perspectives in this ever-evolving 2025 world we're living in right now. And thanks to everyone else who joined us today as well.
Yeah, we really appreciate everyone's time and participation. Hope you got not just some data points, but also some of the pulse, I would say, we're seeing in the first few weeks here, going into September and the end of the year and setting up for 2026. The market, Southwestern Ontario, Canada, and abroad really continues to evolve. And that also includes, the commercial real estate landscape. Definitely seeing some windows of opportunity, some areas that we do need to be diligent on watching the data points. And so we're always here to support anyone who wants to continue the discussion. We're available anytime and happy to help your teams any way we can. So on behalf of our entire JLL team, thanks again for joining us, everyone, and we look forward to reconnecting with you again soon. Take care.
Thanks. Bye.